Good evening, team.
Good evening.
All right, we just recently were notified by McDonald's audit committee that they want us to be their new external auditor. Now, you guys know before we take on such tasks, we have to do some examining of ourselves before we take on this new project. So, before we begin, we have to look at their financial stability, and also since their last auditor was EY, we have to talk to the predecessor and see how things were going on with them, if they can give us any insight on the company. Okay? All right.
And we also have to make sure that we're independent from McDonald's before we take on this engagement.
Good call.
My brother-in-law works. He's a CFO of McDonald's Corp. But I haven't talked to him in the past 5 years. Do you think that'll matter?
No, because Rule 101 of AICPA's standards, that does not break the independence. It's only your immediate family, such as spouse equivalent, and then your outside immediate family, like your parent or things of that nature. It doesn't include brothers-in-laws.
Dependents count as well, right?
Yes.
Mm-hmm.
All right, well, we all know McDonald's is a multinational company, and they operate in different regions of the world, including Africa, Asia Pacific, Europe, the U.S., things like that. They have company-operated stores and they have franchisees. Company-operated stores are closing into, 6,714 stores, and franchisees are closing into 30,000. They operate in the limited service restaurant industry, and their sector is hotels, restaurants, and travel. Their main menu includes fish fillet, quarter pounder with cheese, chicken nuggets, chicken specialty items such as McFlurries, sundaes, apple pies, and things of that nature.
Well, due to the fact that they operate in different areas of the world, we kind of already know the risk they should have when it comes to the currency fluctuations and the pricing and promotions in different countries and different areas and the economic conditions of those areas that they're operating in, which plays a key factor when we come trying to analyze our business risk.
Due to the fact that they're in the restaurant business, some of the things that we can focus on within the business risk are property acquisition management, human resource management, and inventory management. In inventory management, there's such risk as inventory being damaged or spoiled once it arrives. And then because of that, they'll have to throw out some of that, all the spoiled food, and then that will result in a loss of inventory. There's also the fact that they may not receive the inventory that they purchased.
So, wait, would a business risk be like supply chain interruptions or things along that nature, or?
Yeah, those are some of the business risks.
Okay.
What about inventory being stolen from the employees once it gets to the plant?
Yeah.
Or an operation.
Yeah, and that could also be caused by unfavorable economic conditions. Because when there are unfavorable economic conditions, like such as the ones in our recent history, that leads to the employees wanting to take some of that, and that will result in our cash decreasing, and then we don't have the sales to balance that out.
But will that be material to McDonald's? Will they see a loss in that if the inventory is stolen?
They could.
But how big of an effect will it have on the inventory? Their financial statements.
It just depends on how many people. That we can't tell at this point. But that would be an indicator that some of their cash is getting stolen, some of the inventory is getting stolen if those accounts are off. Like if they're decreased throughout the year.
Quick question: would the inventory or cash stolen from the franchisees, would that materially affect the corporation as a whole?
Well, it depends because of the number of franchisees McDonald's has. The franchisees are still obligated to pay royalties to the corporation despite theft happening between cash and inventories. It will only materially affect the corporation if company-owned stores were doing it because they have direct ties with them as a whole.
But back to the theft by the employees, that also transitions us into potential risks within the human and resource management business process.
Yeah, because McDonald's wants to make sure that they don't hire or keep incompetent or unethical employees, because that leads to numerous misstatement possibilities.
That's a good point that you bring about, because McDonald's employees they may tend to give more food than necessary for the receipts. They also could steal from the cash register once it's open, or not put the correct amount in, or not take the correct amount out by pocketing Possibly.
That's true. And since we're dealing with the unethical employees, another risk that may arise is ghost employees, which is clocking in employees who are not actually there or before they actually get there to make it seem like they were on time, which is them leads to McDonald's overpaying their employees for who aren't there.
Yeah, and their financial statements could be overstated, like you said.
Their financial statement.
Financial statements could be overstated.
Yeah.
And if financial statements are overstated due to this, then that mean that the wages payable, accrued payroll would be, it'll be overstated, and they wouldn't have the compensating sales or revenue increase in that.
Would it actually be overstated, or would it just be the employees being overpaid? Because the transaction actually occurred, but it's just them not being there, so they really didn't earn that payable.
Yeah,
True, that's true.
So that's also a risk.
Another factor that this brings about is that's in great concern is the plant property acquisition management and the cost that derives from the repairs and maintenance of the equipment. We're trying to figure out if if the repairs and costs actually exist and are they recorded at the correct amount.
Okay.
Other potential misstatements in there would be failure to record the disposal or the retirement of that property itself, which leads to other economic.
Yeah, on some of the financial statements, we want to recognize if McDonald's recognized that sale of the property as ordinary or a gain on capital. Like, is it an ordinary gain or a capital gain?
Okay. Also, being that there are two different types of leases that they partake in, which is one being ground, which is leasing the property, but they own the building or their franchisee own the building, or improved leasing, which is they lease both the property and the building. They need to thoroughly classify that and keep records of that for proper depreciation and valuation of that account.
Okay, now we just have to figure out how we're going to. So, do y'all want to continue and figure out how we're going to test it today, or we're adjourned tomorrow?
We can readjourn tomorrow. I'm kind of hungry right now.
Okay.
Good morning, everybody. How everybody doing today?
You're good,
Good morning.
I'm doing well myself. But after our meeting yesterday, I took the liberty of going over the inventory, the horizontal analysis for the inventory. And I saw that McDonald's had an 11% decrease from the previous year. This could possibly be due to theft or the products had expired. They just threw it away because they couldn't do anything with it.
But can it also be due to selling off company-owned stores to franchisees? That will also decrease inventory because they don't keep track of franchisees' inventory.
True.
And it could also, we could also test this by physically examining if the inventory at hand on a certain date is the same as the inventory in their books. And that would test for us to make sure that all inventory is recorded, that all inventory actually exists, and that the books are evaluated correctly.
And the test of a control that we can perform is just observing to see if the managers are comparing what was on the inventory to what was on the purchase order.
All right, so that's how we'll test internal controls for inventory management. But what about human resource management?
For human resource management, we can perform data analytics. And if you don't know what that is, the type of data analytics we perform is data mining with the payroll-related databases. With that, we will look at the valid employee IDs and compare it with the cash disbursements. And this type of information is more accurate than a typical value is confirming if an employee exists, because it will pull up the job code, employee ID, locations, and start date, which will give us more information and more assurance.
Okay, and then the data mining as well, would that also tell whether or not the employee was fired, so it will have an end date, so it would include that employee?
Yes, typically they would as well.
Okay.
So that would also be a good way to test transactions.
Yes.
Okay. Say is and the main things we're concerned about with property acquisition is just inspecting documents as they relate to disposals and make sure they're accounted for properly.
Okay, so the counts that would be affected when we do our testing and risk assessment for inventory would be inventory at cost. For property and equipment acquisition, it would be net property, goodwill, and long-term debt. And for human resource management, it would be accounts payable and accrued payroll and interest. And due to the nature of McDonald's, the inherent risk we will have to test cash and accounts receivable due to the nature of the industry. What did you guys find out when you went out in the field and did your sample of the stores and internal controls?
Well, I went to one outside the headquarters in Delaware, and I'm assuming that it was owned by McDonald's and not a franchisee. So there I seen one of the employees, they kept swapping cash registers, so multiple employees were on the same cash register. So if any cash would come up missing or anything of that sort, we wouldn't be able to trace who actually took it. And that will result in the cash account being decreased and not really having any internal control to actually verify which of the employees misappropriated.
Oh, okay. So, okay, I understand. Anybody else?
Yeah, well, I went home a couple weeks ago and I ran into one of old friend of mine, and apparently he still works at McDonald's. Not trying to be funny, but anyway, I ended up I looked at my receipt and I received a discount, employee discount. When obviously I'm not an employee, it was a pretty good, decent discount. Got almost 50% off my meal. I mean, even though it may be it's immaterial to them. If a lot of those transactions happen on a daily basis across the board to all the franchisees, that may be material to them in some sort of way.
Oh, because they're taking away their sales and
Right,
the corporation,
yeah,
they get a percentage of the weekly sales and things like that. So
Right.
it'll be decent. Okay, all right.
And I'm going to take what I seen as a control deficiency, because I went to a McDonald's and I noticed that they give out the cash receipts after you order, but they never check when they're collecting to pass out the food. This part affects the existence of portion of management assertion, because anyone can just come up and walk up and collect food that they didn't purchase for themselves.
Also, when I went out and just observed how the restaurant was working and controls in place, I seen an employee clock out for a break, then clock back in after her break was up, but still she was sitting down. I guess it was not a manager there present to supervise anything that was going on, but that leads to McDonald's overpaying their staff because they're not actually working, but they're getting paid for it. So that's a control deficiency as well.
It seems like we have a lot of work to do with, I guess, implementing a coastal activity to help them mitigate some of these risk or control failures that they do have. Through our analysis of the financial statements, we concluded that there was a significant decrease in many of the accounts, and these accounts include cash and equivalents, accounts receivable, inventory, and plant, property, and equipment.
This can be explained when we looked further in our footnotes of disclosures and did a little more research. These decreases in accounts receivable, PPE, and inventory can be explained by McDonald's frequent disposal and acquisition of properties. This will mean that they will no longer be receiving those receivables from the franchisees or sending them that inventory.
Our recommendation to management to prevent potential misstatements and risks are to utilize ELC 14, which is require reports to be reviewed with management on a monthly and a quarterly basis, as well as ELC 11, which require key personnel to have appropriate qualifications as well as experience, and also ELC 9, which requires the journal entries to be reviewed and approved by the general.
In our opinion, the financial statements are presented fairly in all material respects. The consolidated financial position of McDonald's Corporation at December 31st, 2014, and the consolidated results of its operations are in conformity with generally accepted accounting principles. We have also audited in accordance with the standards of Public Company Accounting Oversight Board, McDonald's Corporation, internal controls over financial reporting as of December 31st, 2014, based on the criteria established in the Internal Controls Integrated Framework issued by a committee of sponsoring organization. We have expressed an unqualified opinion thereon.
After the pain, you come.